Time check, 7:57. All right, folks, jumps on here, 7:57 Eastern time. Still a little bit light outside, which is nice. Just going to go over a couple of Q&As I've received over the last week or so. Got my list here, and if anyone's jumping on board, they want to join in, by all means do so. Would like to hear your own questions for sure. So we'll wait till we get started here in just a second. I'll tell you what, let me go over here. Go to YouTube. All right. Oops. There we go. All right. Got a couple people signing on there. All right. All right. See if hold on just a second here. Happy Wednesday, my friends. Happy Wednesday. Beautiful day here in Georgia. That's for sure. Let me get my thing up here. All right. Hold on just a second. Blink. My channel. There we go. Click on that. All right. Oops. Hey, everyone. Happy Wednesday. All right, cool. There we go. All right, cool. Thumbs up. Bruce, what's up, man? Right on. Good to see you. Good to see you. We're live and in person. All right, cool. All right, good. That's fantastic. Appreciate you all being here for sure. Got a couple things to chat on, and then we'll dive into any questions anyone has to ask or thoughts or comments or anything like that. I was doing a video earlier today on the Unison, hey Cheryl, Unison thing where it's a shared equity, and I thought that was pretty neat. Actually, I'm not sold on it 100% yet, but I thought that was pretty cool. The Unison thing where you have a home equity line, you have reverse mortgage, and you have a third option to access the equity in your home by basically selling essentially what you're doing to Unison a part of the appreciation. I thought that was ingenious actually. And what they're doing is they're taking their investors from long-term investors, pension funds, endowments, insurance companies, whatnot. And these folks have a long-term investment time horizon, so they can take on a whole lot more risk, which means, for them to capture, say, 7 to 8% year-over-year rate of return from now until the time the loan has been liquidated, i.e. sold, you sell your house, they can wait for that, especially this low interest rate environment. I thought that was pretty neat, actually, this Unison. I'm surprised, actually, I haven't heard anything else about it, but that was good. So that was a good, I appreciate that. I'm hoping to get that one of those folks on the web, my podcast / YouTube channel so we can ask some questions. Secondly, there's a lady from Danielle Howard, Boomers Medicare. I forgot the name of her program. I forgot, but she's out of Fort Worth, Texas. And she and I are going to be doing a couple of joint calls in YouTube channels. Danielle Howard, I could have sworn it's her name. Boomer Benefits, boomerbenefits.com. That's what it is. And she has a huge Facebook presence, not a huge YouTube presence yet, but a huge Facebook presence. So I think April 1st, we're going to do our first joint session, she and I. And I think she's going to be more asking me questions about, personal financial planning, retirement planning topics. And then we'll wait for another week, and I'll be asking her questions on Medicare stuff. Now, she's licensed in every state except for New York, Massachusetts, and Hawaii. So join in, and I'll let you know, because if you have questions, you definitely want to be, hey, Curtis, you definitely want to be, Curtis Brooks. Is that my man Curtis I used to work with? I used to work with a Curtis Brooks. Anyway, she's going to be asking questions about so I'll be asking her questions on Medicare supplements, actually insurance before you hit Medicare. So if you have any questions that you want me to relay back to her, what's going on, Tim? By all means, let me know. And I'll more to come on that for sure. But I'm not a Medicare expert. We got Alabama right on. Cheryl said about Danielle Howard, she watched her seminar last week. Very informative. I'll be using them in a few months. So I still love my man J.O. up in Michigan, but now I got Danielle in Texas. So kind of splitting the states. I got the north part with Jay, and Danielle in Texas. I like that a lot. And so usually people say, who should I talk to? I like to have 2 or 3 people and let you all decide. 2 completely different personalities. Jay is definitely a different personality than Danielle, and it's neither good nor bad. But some personalities rub people wrong. Some personalities are just spot on. I mean, believe it or not, my personality can rub some people wrong. Crazy, but it does. How much money should you have in a stable value fund from a 500K portfolio? Right on. William Burkhead from Baltimore. Good to see you, man. A good friend of mine lives in Baltimore, as a matter of fact. Baltimore. And believe it or not, William, I was there when Cal, not only did he played 4 games, a 4-game homestand against the California Angels. This guy right here was there. I was there when he broke the 2030 Lou Gehrig consecutive game streak. Your old buddy Josh was there. So I've always been a fan of Baltimore, the Inner Harbor and stuff. Baltimore has problems, obviously, but I've always been a fan. Never liked the Baltimore Ravens. Can't lie. Can't stand the Ravens. Always can't stand the Ravens, but I've always been an O's fan. All right, so how much money should you have in stable value? Man, Doug says, how much money should I have in stable I'll answer that here in just a second, Bruce. How much money should you have a stable value fund? You got $500,000 in your 401k. I don't know. I mean, the issue, my contention is a couple of things going on there, Doug, is, how much do you need to spend? And I was going to, I still have it up there. I'm going to address this a little bit here tonight. But if you need $40,000 to spend, I think you should have, and you're only getting $20,000 from Social Security, I'd have $60,000 without question. So we'll just use a little white chart here thing. So we got 500K is what we got right there. And we're spending, we'll just say 60,000 a year in spending. All right. And we're getting 30K from Social Security. All right. So we got 500,000 is 401K. That says 60K, if you can believe that. 60,000 spending, of which 30,000 is coming from Social Security. So we need 30,000 a year to make up the difference. So basically, we're looking at 5,000 a month between total spending. So we need that right there. I would put I'd put 90K in cash, stable value fund. So I would take this. I have 3 years covered of cash. The rest would be in 410 would be in the stocks. And again, that's the epitome of the barbell approach, which I love. I'm not, as you know, I'm just not a bond fan. I'm never going to yell at anybody for being bonds, but this is my approach right here. It's very simple. You got cash and you got stocks. Literally, that's it. Cash and stocks. I think it's you got enough cash to cover 3 years, ideally, for spending after Social Security and pensions and whatnot. And the rest should be in stocks. I don't see any value at all in bonds. Now, with that said, do I like Wellington funds? Sure, absolutely. I love Wellington funds. 70% of the fund, 30% of the fund is in bonds. So does that mean I'm against Wellington? No. It's just the challenge that we have still is that the interest rates. Let me just draw this out. I'm going to draw this out forever. I'll do it all the time. I don't mind doing this at all. So a bond works like this. It starts at 1,000 as a par value, 10,000, 25, it doesn't matter. We just use trading at 1,000 is typically what we say for a bond. It trades at 1,000. And it matures at 1,000. It's literally that simple. So bond issues at 1,000, matures at 1,000. So let's just say you're getting 5% interest. Well, that means you're getting, what's that, $50 for every $1,000 you have in there. 50, 50, 50, 50. I mean, it's literally the easiest thing in the world. So it's issued at 1,000. It pays $50 every single year. It matures at 1,000. You're not getting any more or less. It's just not. The only way you get less if this guy goes kaput, bankrupt. You're not getting more or less. And so the issue with bonds, they're not paying 5% now. 10-year Treasury is paying. Let's see what the 10-year Treasury is doing right now. It's paying. 10-year Treasury. Man, look at that. 2.53. Look, it fell off a cliff right there. See that TNX? That's a 10-year Treasury. It fall. What caused that? That's nuts. The markets fell pretty good today. So that must mean. So all right. So if you see here, when the markets fall off, so the Dow is down, Nasdaq was up though. Well, the S&P was down. Anyway, let's just look at the Dow for an example. So the Dow was down, was at 100-something points, and the bond, the 10-year Treasury fell. The yields on the 10-year Treasury fell because the demand of the bonds went up. I cannot stress that enough. Yields go down when demand goes up. The demand goes up, makes the prices go up. When the prices go up for bonds, the yields go down. And so if you bought that bond today, right now, that 10-year Treasury, you're getting all of 2.535. We'll just say 2.5%. That's it. You're still paying tax on it. Inflation will just say 2. There's just no money to be made in there, none whatsoever. And yet you're locking up your money for 10 years. Don't do that. I mean, look, I like 10-year Treasuries, but I mean, you get, and this is the problem with the flat yield curve that we have right now. I mean, you get a 1-year CD. Hell, someone's saying Vanguard Prime Money Market is paying 2.4. So I don't get why anyone lock up their money in a 10-year, 30-year Treasury is paying 3. So why would you lock up your money for that long when you can get liquid money at 2.5, 2.4, CDs at 2.8? I don't see the benefit of that whatsoever. So going back to Wellington Fund, yes, they did well in the latter part. In 2000 to 2010 chaos, Wellington did pretty well. The days of bonds, though, giving you any kind of decent rate of returns are over. It's just no getting around that, and it's never going to go back to normal anytime soon. It's just not. The federal government has a perverse incentive to keep rates low. We don't have the cash. We cannot afford the liabilities that we have now. I'm not saying anything that no one knows. If we were to raise rates to even just spitting distance of historical norms, the number one line item after, I think, Medicare would be the interest on the debt. There's no money for that. We don't have it. We don't have it. So rates aren't going up. I mean, they could, I guess, but they're not. So keep it short on the short end, i.e. with cash, and being a cash with, CDs, like I talked about in the video I did the other day, stable value funds, or just the prime money market. What a great place. Park, $100,000, Doug, in the prime money market account. Be done with it. Put the other 400,000 in stocks, man. I think it's a good move. Do I use a dry rub, my man Bruce? Do I use a dry rub before I barbecue? Oh yeah, absolutely. In fact, I just got done making some new beef jerky. I can't wait to sit right there. Just turn it off. That's not barbecuing. That's dehydrating. But man, it's good. My man Curtis says retired. Yeah. All right. G Fund, perfect example. So Curtis says I'm getting ready to retire here in a little bit. Consolidating my money into the G and VOO. G Fund's perfect. Perfect example of cash, a stable value fund for TSP. G Fund's perfect. Huge fan of the G Fund. Huge, huge, huge. So let's go back to what Doug asked. $500,000. I'm going to say 100,000 in the G Fund if I was the TSP, and 400,000 in stocks, like my man Curtis did. Is VOO, is that the total stock? I can't remember what VOO is, but yeah, I'm very comfortable with your move there, Curtis. Billy, you've mentioned Jazz Wealth. Can you expound on what you think? Yeah, I love Jazz. I'm a huge fan of Dustin. I think Dustin does great work. I love his videos. He's a righteous dude. I know him. I interviewed him, and one of these days I'm going to drive down to Florida, and we're going to do a joint meeting like this at some point. I think his fees are absolutely reasonable. I think I don't know. Once you break 250,000, it's like 0.49, and I just think that's incredibly value added for sure. On the low end, like 0 to 25, I think is 1.5, and that's just because of liability. I'm telling you, I've been in this business a long time, and believe it or not, the people who sue advisors tend to be on the lower end of the spectrum, and that's one of the reasons why they have to charge a higher fee, essentially to cover the cost of compliance. So that way, if they do get sued, they have errors and omissions, insurance, and whatnot. Generally speaking, the people who sue the most are the people with $30,000, $40,000. So Dustin, he can't, if he's going to take that liability, he's going to have to charge for it. So the lower end of the spectrum on value, just a more risky. And if he wants to get served those people, which he absolutely does, he's going to have to be charged accordingly. Now, that's me. He didn't tell me that. I'm just telling you, I've been in this business a long time. I know that for a fact. The people who sue the most are the ones on the lower end of the spectrum, which means you got to charge more in order to protect yourself. There's just no getting around that. So I'm a huge fan of Dustin. Love what he does. No clue how his portfolios do. I got to tell you guys, I frankly don't care, because if you have a diversified portfolio, your fees are minimal, you're going to be just fine without question. So big fan, give him my without question, my recommendation. I get no fees from Dustin. We don't, nothing like that. We don't switch. I refer him only from what I see out there. My man, Jack Zarinsky up in Fairfax at mysafebridge.com. Huge fan of his too. And the reason is because I know him. How do I know him? Because I saw that they posted their fees on the front page on their website, Dustin and Jack. Who's the lady in Phoenix I was looking at the other day? Heirloom Financial in Phoenix. I don't know her. Wendy Hubbard, I think is her name. Fees on the front page. And if they're putting the fees on the front page, I want to send them as much business as I possibly can to reward them. And I tell you, man, so Jack Zarinsky up in Fairfax, fees on the front page. Dustin, fees on the front page. Wendy Hubbard, I'm almost positive that's Wendy Hubbard. In Phoenix with Heirloom Financial, I have no clue. I mean, these guys, she might be, I don't know, freaking Alexandra Ocasio-Cortez's sister. I have no idea, but at least she puts her fees on the front page. Hey, Billy, I'm with Jack. Oh, there's my man, Bruce. Yeah, Bruce, right on. VO the 500. All right, so I just encourage, don't overlook small caps and international ones as well. That's for sure. I'm considering the triple Qs. No, I got no problem with triple Qs. I'm a fan without question. So Bruce Curtis says he's considering the triple Qs. I got no problem with that at all. None in the least. You and Dustin would be great. Yeah, I'm a fan of Dustin. He's a good guy. He cracks me up. He's a guy. He's more interested in the investment part than I am. The investing side, frankly, bores me because it's just. I mean, it doesn't mean Dustin's bad. It just, for me, it's just like I've heard all the stories so long. It's just everything is just silly. At the end of the day, the market is the market. You're going to capture the market minus your fees. There's if the market's 8%. And I'm getting set and I'm getting 9%. Inherently, someone else has to do less than 8%. There's just no getting around that. So can I get 9% consistently, repeatedly while I'm charging 1.5% fee? No, you can't. Jack Bogle's book, Common Sense on Mutual Funds. Actually, I was talking to Jack today, not Jack Bogle, but Jack Zarinsky. And he was telling me about the new book that Bogle had written. You know, obviously Bogle just recently passed. The little book on investing, which Jack says was a great read. So I'm looking forward to reading that too. But I mean, the market is the market. The market gives you 8%. That's the average return. So with fees thrown in there, after you've taken all the fees in the average market, the average person is going to get less than the market inherently because the market is only giving you 8 and you're going to get the fees on top of it. It's just, there's no getting away around that. Will there be a Warren Buffett and a Peter Lynch? Yes, there'll always be. Can you identify those people before they are the Warren Buffett and Peter Lynch? No, we don't know. It might be luck more than anything. I want to read you something real quick. I thought this was pretty interesting. I just posted on my website, on the YouTube channel. And in the behavioral life cycle hypothesis, Hirsch Sheffrin and Richard Thaler. Anyone ever heard of Richard Thaler? Posited that individuals create 3 separate mental accounts composed of current income, current assets, and future wealth. Sheffrin and Thaler argue that individuals have a greater propensity to consume from current income, which would include dividends and interest, than from current assets, which includes investment capital and a capital appreciation. Malcolm Baker, Stefan Nagel, and Jeffrey Wergler confirmed in the effect of dividends on consumption that the propensity to consume from dividends is far higher than from capital gains, and in fact is similar to the propensity to consume from labor. Now, the reason I wanted to read that to you is because it goes back to my thesis on why people spend less in retirement, because this is pretty much proven now at this stage. People spend less in retirement because they have a capital asset that they're pulling money from, and it scares the heck out of them. Whereas people don't spend less and while they're working because they have this thing called current income. Going back to why people have a preference for dividends. They like the idea of current income coming in. It's very, very interesting. And Thaler won a Nobel Prize in economics because of research such as this, behavioral economics and whatnot. And I just find it to be very, very interesting. Going back to what Curtis was saying about having money over here and over here. So if you go back to my barbell approach, this is income, this is capital asset. So you got income, that's your cash, and that's capital asset. That's your investments, your VOO and whatnot. So this right here, people are very, very sketchy to draw from because once it draws, you can't just put that money back unless you get appreciation. Income, on the other hand, people are less sketchy to draw from because it's mental accounting. It's like a form of income from your employer, a checking account. It's like money that's there that you can draw on without really worrying about it at night. And the whole point of, my opinion, retirement planning is mental accounting leads more than any kind of theoretical rational thought or rational behavior that a lot of financial planners like to talk about. The financial planner is going to say, oh, we need you here, we need you here, we need you here, we need you here, take 4% a year out. It doesn't work like that. I mean, it works on theory, but it doesn't work in reality, because people need to see that's my cash money, that's my growth money. I'm telling you, that's why the 2-bucket retirement approach is wonderful, because it just solves the mental accounting. You're like, I got enough to cover for 3 years. I don't have to sweat it when the markets go down. Do you know a recession happened? I'm going to do a video on this tomorrow to show you, though. And if you didn't see my video I did yesterday, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 recessions we've had since 1948. 11. So the base of a recession happens once every 5 years. So just think about it. You just retired. Recession's coming. That guy from Money GPS. Recession. Yeah, recessions are always coming. And so just think, if you don't have this mental accounting situated correctly, where everything is in the market as a whole, and you're thinking 4% a year, and then we get a recession, market goes down 15, 20%, you are freaking out. Yet if you have the cash sitting there to cover you for 2 or 3 years, you're scared, but not nearly to the same extent as somebody else. That's just my opinion there. All right, let's see what we got here. Nancy's on board. Hey, Nancy. Hello. Nancy, she had posted the other day a couple times now that when she went to Social Security, they looked at her like she had 2 heads when she asked about spousal planning, the spousal benefits. For the love of the good Lord, if a Social Security office does not know what spousal benefits are, I don't know that scares me to death about the state of our government. That's for sure. Not that I'm not always scared about the state of our government. And she went to 2 different offices. So, from Nancy's words to your ears, if you are going to Social Security, print off the website that says whatever you're trying to accomplish, spousal, survivor, just anything, just print off. So in this case, spousal benefits, you say there's it could not be clearer on the SSA.gov, spousal benefits, print off and take it to them. So you can say, this is what I'm talking about. If it's survivor benefits, print it off, take it down there so they know what you're talking about. I boggles the mind how just inept that would be, that they don't know what spousal benefits are. And Nancy said she was married. So the only thing I could think is maybe not married, but she said she's been married for a long time. So absolutely no reason she can't have a discussion about spousal benefits. That doesn't mean she's necessarily going to qualify, because remember, the spouse has to be drawing before you can get spousal benefits nowadays, but they should still be able to have a discussion with that. I mean, this is boilerplate stuff there. So just let Nancy's frustration help you folks to say, if you're going to talk to Social Security, bring some kind of documentation off of SSA.gov. I will tell you too, when it comes to survivor benefits, I'm telling you right now, understand what happens with survivor benefits. Survivor benefits, you can still take the least of your own or the survivor benefit and let your own grow. And your survivor benefit doesn't really grow, but you can still, the survivor benefit might be higher. A lot's going on here, but just remember, you can take your survivor benefit now and let your own benefit grow. You can absolutely do that. So if you go down there and they say, hey, Nancy, your husband died, that stinks, but you should take your benefit today because it pays more than your survivor benefit, you should say, no, I'm not doing that, unless there's some kind of situation dictates, of course. But you say, no. I want to take my survivor benefit in order to let my own benefit grow with 8% delayed earnings credits. Now, a lot of people at Social Security don't know this, for the love of me. I mean, this is just mind-boggling, but that's on you, man. Not you, Nancy, but that's on you to get your stuff together. So, Nancy, I don't know what to tell you. Try it again. Maybe go to a different branch. You call, if nothing else. That's nuts. 60 here today, first grilling of the year. Yeah, right on, man. Oh, I love the spring. Spring is freaking awesome. Kevin's from Sunnyvale, CA. Right on, man. William says I have 4 years to qualify for a 700 pension. So can take Social Security in 2 years at age 66. I was thinking of using a 32K Social Security, my 401k, or taking Social Security. My preference is always to defer taking Social Security as long as I can. Can't get better than 8% guaranteed rate of return from the feds for delaying, plus a cost of living adjustment that never goes away. I've done a couple months ago, I did some videos, some pointy head professors talked about the Social Security arbitrage. And they just ran the numbers relative to various arbitrage techniques, and Social Security arbitrage, i.e. delaying, is simply the best game in town. There's just no getting around that. Look, now everyone's situation is unique. I get that. But I think a lot of times people also forget the tax benefits of Social Security as well. That's for sure. So defer if you can. I mean, without question. I don't hesitate to recommend that, just blanket. Am I comfortable with 20% cash, 80% on my IRA? You should have 35. I'm comfortable with having 3 years of cash, Curtis. So whatever 3 years of cash you need, if you spend $50,000 a year and $20,000 has come from Social Security, you would want $90,000 of cash. So whatever that equates to, I'm very, very comfortable with that. 35% cash seems on the high end to me, but it really depends on your spending. I mean, see, that's the thing with traditional retirement planning. It's ass backwards. We got to focus on what we need first, not what we have. And if we need $50,000 a year, of which $30,000 comes from Social Security, well, we need $20,000 a year. If we need $50,000 a year and we're $10,000 from Social Security, we need $40,000 a year from our investments. We got to figure out what our needs are first, and then we got to figure out how to make those needs happen with what we have. So reverse the scenario, not just say 35% cash. We got to say, how much do we need? 3 years of that in cash would be my recommendation there. Let's see. So Kevin says the Roth IRA 5-year rule. When does the clock start? When I opened my first 15 years ago. Yeah. All right. So the clock starts when you have, all right, Roth. All right. So here's a couple of things going on. So the 5-year rule on a contributory Roth starts when you open the account. There's no question about that. When you do a Roth conversion, the last I read is there's no guidance, what's called a private letter ruling from the IRS that says explicitly how this works. But most practitioners who are on the safe side, of which I am, would say each Roth conversion is its own 5-year rule, if that makes sense. I mean, I'm just telling you, in my opinion, so your contributory Roth, you have two. One's a contributory. I put $6,000 in. I did it 15 years ago. Anything I contribute to that now is free up to 5-year rule. You're good. My converted Roth, on the other hand, from a 401k, a traditional IRA to a Roth, each of those unique conversions have their own 5-year rule. This is the way I understand it. Now, again, I'm telling you, I'm sure somebody say, nah, but there's been no explicit guidance from the IRS that says you're going to be safe, Kevin. So I would just look at your contributory, the one you did 15 years ago. Anything that goes in there as a contribution, you're good. Your Roth conversions, I don't think that's going to be the truth. So let me give an example for me. I always thought I'd be sneaky. My contributory Roth, have a couple $100 in there, start doing Roth conversions each and every year. And that'd be open, right? That'd be open to be free and clear from the 10% penalty because I'm under the age of 59 and a half. And then once I hit 59 and a half, they'd be free and clear from any taxes. That's not, the IRS is on that. I don't know how else to say that. The IRS knows you have a contributory Roth, and from 5 years ago, which is fine. Now you're converting to your contributory Roth, and you think you should be able to have access to all that money, at least penalty-free, if not income tax-free, even though 5 years hasn't transpired since you did the conversion. Yes, that's my thought. No, that's not going to happen. So just keep that in mind. Every conversion has its own 5-year rule. That's the safest bet there. Let's see. I can see that having to help mother-in-law the finances, she's very shy about. Yeah, no, right. So Cameron says, drawn from capital scares the hell out of people. No other way around that. Scares the hell out of people. I mean, I use myself as an example. I mean, when I quit my job, I'm drawn from my capital. And I tell you, man, I used to buy all kinds of crazy stuff on Amazon for gardening and whatnot, all kinds of various things for techniques. And I don't do it anymore because it's scary. It's scary to have to draw down your capital. Thinking of retiring, says my man Al, this year have an extra $300,000 in cash. Thinking of laddering CDs. Yeah, that's and putting the other into American Fund, Growth Fund, and New Perspective Fund. The only thing about New Perspective Fund, I love it. The only drawback is it has a lot. You're going to have some duplication there with the Growth Fund of America, because the New Perspective Fund, it used to be, is it 70% domestic stocks and 30% international, or is it the other way around? I can't remember. I think it might be 30% domestic. But there is an S&P as blue chip domestic stock component, a significant amount there too, Al. So I'm a huge fan of New Perspective, without question. A huge fan of Growth Fund of America too. There just might be some overlap there. And at the end of the day, will that kill you? No. Just in the back of your mind, just remember you're going to probably have a couple duplicates there. It's not really that big of a deal. 64 last year. All the funds in our investment suite at work were negative last year, and no one was talking about this. 60. I think last year I think it was bad across the board, man. I don't think. Did anything do positive returns last year? I don't know. I'm not sure. Off the top of my head, I don't think bonds did. No, bonds did not. S&P 500 didn't. I don't think the Russell 2000 did. I don't think anything had a positive return. Maybe commodities. I think, actually, I don't know. Real estate investment trusts, I'm not sure. All right. Heritage Farms, right on, man. Heritage Farms got a YouTube channel out there, and I'm hoping that's working for you, Heritage Farms. I forgot your name was Scott. Scott, was that it? I can't remember. Great from north of San Antonio. Where at, man? We lived in Bernie for 3 years. Bernie's just gone insane now. I don't know if that's where you are from. Great Riff is here. I imagine you're a guitar player. Grover from the great state of Illinois. All right, Illinois is in a wonderful place financially. Converse, Texas. Okay, there's a place out in Kendall County, Comfort. It was a Comfort. Oh man, I loved it out there. I could handle that. A little bit too hot for this kid though, so I can't take it. All right, so Steve say I'm selling my rental to pay off my mortgage. I'm thinking this is a good time to do this since I've retired. Yeah, I don't know. My inclination on real estate is such, and I'll say this till I'm blue in the face. There is a lot of baby boomers retiring, and they have lots of houses and second houses, be it rentals or vacation homes, that they're not going to want to use anymore. And I have a sneaky, and then they're going to want to downsize too from their big houses that they bought with cheap money. And so my inclination has been for a long, long time that there's going to be a flood of stuff on the market, and you're not having a flood of buyers because all these millennials don't have any cash because of freaking student loans. How they've been snaked, they've been lied to by the administrators of these universities that the college degree is their ticket to fame and fortune. And so what's going to happen is you got this huge supply and not a huge demand. Never mind that the baby boomers are a huge generation anyway, and I'm not so sure about the millennials. So big supply, not a big demand. That tells me right there's going to be a price reduction. Now, on top of that, and see, I don't think interest rates are going up anytime soon. I have an adjustable rate mortgage to validate that. My thought on that doesn't mean I'll be right. I tell you, I've been killed many more times than Sunday, which is why I wrote this book right here, Strategic Money Planning. Shameless plug, because I was kind of telling myself what I wish I would have done differently when I was younger. But anyway. I have an adjustable rate mortgage. I don't think rates are going up, but let's just say they did. I mean, the facts are if interest rates go up, it makes the money more expensive. Money more expensive inherently means people are being priced out of the market for homes, or the sellers are going to have to drop the price. So, yeah, I'm hoping I'm back up here. Should be back on. Am I back on there? Lost the stream. My back. Oops. Okay, sweet. So I think the demand is going to drop and the supply is going to increase. And when you have that, that's bad news. So going back to your question, Steve, I don't know your situation. I'd liquidate that. I have no idea about your capital gains, no idea about your situation, no idea about nothing. So don't take this as advice. All right, right on, cool. All right, cool. So it looks like, thanks, guys. Love your channel, Josh. My man Barry, I've been emailing my coworkers. Right on. Hey, man, the more people that watch this is going to sound crazy, but one of the reasons that I didn't want to take clients on anymore, because I actually enjoy this. The funnest thing I've ever done was doing this YouTube thing. It's nuts that you all are actually here. Listen, this guy, I find it to be incredibly humbling, but I'm in gratitude. I just nuts. But I like doing it. And so I think there's a lot of people that can fall prey to negative Nellies out there. And there's many, many, many on YouTube and obviously in the mainstream media and whatnot. And And look, I'm not trying to whistle past the graveyard, but I think if I can help people to just relax a little bit, that'd be better. I think that'd be better for everybody. And one of the things that is enlightened, enabled me to do more videos is that, again, I'm just not taking clients on because I just want to focus on this where I enjoy it and probably reaching a bigger audience as well. So I appreciate that, what you said there, Barry. Hopefully people get something out of it for sure. Rexpo from North Carolina, curious about your thoughts on precious metals. I think it's a good sounding idea, but worthless in real life. Worst case. All right. I'm not sure about precious metals, the mutual fund or anything, but I am. I think you should have gold. Absolutely. Look, this isn't because I'm worried about a zombie attack, but I think history leads people to say gold has had a value at all times, without question. I mean, going back to Jesus, was one of the three things the three wise men brought was gold. And I shared this story with you before, and I'll share it again. But I talked to this guy 5 or 6 years ago. He's African, and is like in Congo or someplace, Cameroon, where there's rebels, and the communists were trying to take over. Some just Boko Haram or whatever. It's just some bad group of people are trying to take over. This is probably the 1970s, I think. And his dad had owned a business. And so his dad was the rich guy or one of the rich guys. And when the commies took over, or trying to take over, they were killing people. I mean, just left and right. Ironically, you'd never hear about it in the news. But anyway, and so his dad had to flee. And if memory serves correctly, the only way they were able to get out, and I think he said he had like 5 brothers and sisters or something big. I can't remember the whole story. But they had gold coins, and they were able to bribe people to take them off a boat over a river, or I can't remember the whole story. I just off that, but over the Atlantic, I can't remember. But they had to take a boat to get out of wherever they're fleeing from before they got just decimated. And the only way they could get on the boat was using gold coins. And that was only the 70s. And the interesting thing was this African guy, black guy, comes to America. With literally, they land in Miami. They don't know anybody. I don't even think they can speak the language. And I got no way to make this validate the story, but I got every reason to believe he's telling me the truth because I liked him, and I don't think he's pulling my leg. Got nothing in Miami. Wake up 30 years later, this guy. I remember he had a like $6 million account. I said, "How'd you get so much money?" And he just built a business from scratch. And if it didn't have the gold, it never would have happened. And only in America. It's wonderful. But only the fact that his dad kept some gold reserves. And look, I'm not saying that's going to happen here, but, no one knows. I mean, no one knows where the next calamity is going to be. I just think Venezuela 20 years ago was the richest country in South America. I know we can say as politicians are nuts and socialism evil. I get that. But the fact is it happened. It happened. It's nuts. Don't get me started. I just think about Cuba versus Hong Kong. All right. So have some gold. I think having gold coins absolutely makes sense without question. 5% of your net worth, or not your net worth, your liquid net worth should be in gold coins. I got no qualm with that at all. Let's see. I'm not a fan of precious metals. You know what I am good at. So if I can ever help the Josh turn, just say so. Right on, man. Appreciate that, Bruce. Just spread the word, big man. Spread the word. To reduce my tax burden after I retire, should I just reduce my IRA at a 4% starting rate at retirement? Theoretically, that would cause me to claim that at the lowest rate. Yeah, I think at the end of the day, once you retire, you no longer have earned income. That's the time to start moving money, man. I wouldn't look at the 4% rate. I'd actually look at the tax bracket you're in. So if you're married filing jointly, you got 100. I'm just going to use my little chart here. All right. So remember, if you're married filing jointly, and this year I think got 80,000 deductions, 105,000 of AGI, 105,000 of AGI still puts you in the 12% tax bracket because you have between 24.4 and 26 something of deductions right there. And that still puts the 12% tax bracket. So I would look at it differently. I'd say, okay, if I want to stay in the 12% tax bracket and I got $75,000 of adjusted gross income, that gives me $30,000 I can play with to stay in the 12% tax bracket. And that will be the lowest tax bracket you'll ever have because once required minimum distributions kick in, it's just going to get bigger and bigger and bigger. And then, of course, when you die and leave the amount to your surviving spouse, he or she will have to pay even more because she loses the standard deduction and her tax brackets go significantly higher. So again, switch it around. Where am I at? Look at my 1040. What is my AGI and what's my taxable income? And then you can start playing around with that. Now, a lot of people say, I want to stay in the 12%. I want to do whatever I can not to go in the 22. Screw that. If you get an extra $2,000 in a 22% tax bracket, it's not that big of a deal. I mean, it's a marginal rate. So the vast majority of your money is still going to be taxed at 10 or 12%. Just a couple thousand extra bucks will be taxed at 20, 22. Just not that big of a deal. Just don't spend all kinds of time, vacillating between, I got to get down to the penny. Yeah, just don't do that. Secondly, along those lines too, I can't tell you how many people say, I need my cost basis to be the penny. I'm going to spend hours trying to figure out my cost basis. And it just why bother with that? Time's too short, man. Too precious. So let's just say you sold the shares $50 a share and you think you bought it at 20, but you're not quite sure, but you at least bought it at 15. You can validate 15. All right, well, you got $35 capital gain per share. Tax at ordinary capital gains, it could be 0, it could be 15%. Why kill yourself trying to justify the extra $5 cost basis if it's going to take you, hours on end? It just doesn't make any sense to save $5 at 15% capital gain. Just don't forget it. Just say, all right, this way I can recognize you probably pay a little bit more tax. It's just, I can't tell you how many people in my career have sat there. They don't know their cost basis, but they had dividends reinvested. They weren't able to keep the cost basis, I'm sitting there thinking, all this time and energy you're looking at just so you can avoid paying an extra $200 in taxes. That just boggles my mind. I don't think that's a good use of people's time. My man Ben, I'm 58. My company just started offering Roth 401k. Yay. I just started contributing the max plus catch up. If I retire next year, can I start withdrawing the Roth 401k at 59.5, or do I have to wait 5 years? You can absolutely start withdrawing it. The question is, will it be tax free? And it's still got to be the 5-year. On a Roth 401k, I'm sure it's still the 5-year rule. I'll talk about it, I don't know. But ideally, you'd want to roll that to a Roth IRA anyway, Ben, simply because the Roth IRAs have no required distributions. So what I'm going to assume is you're going to roll that to a Roth IRA, which you should, and then you still got to wait the 5 years to get it tax-free. Now, you'll always have access to the principal, just remember that, but to get the income growth tax-free, you got to wait 5 years in a Roth IRA. My man Bruce said he already smashed it. Appreciate it. Look at that smash button. Smash the thumbs up. My friend Salma says, very grateful to your chat and videos with true information you got, Salma. Appreciate you commenting for sure. Dave Shalom from Jerusalem, Israel. Right on, man. Boker Tov. I don't know what that means. So elaborate, if you would. Boker Tov. Good morning, everyone. I'm from Israel. Right on. Sergio, my man. There's my man, Sergio. You are killing it. Hello from LA, the city with the most reverse mortgage applications last year. Ooh, I don't know what to make of that, Sergio. I'm not sure what to make of that. Anyway, if you're on the thing and you have, if you notice Sergio's, he knows a whole lot more about reverse mortgages than me, frankly. Maybe one day he'll do his own YouTube channel on reverse mortgages and give us a straight talk. But if you see Sergio on there and you have a question about reverse mortgages, direct it to him. I just know enough to be dangerous from reading a couple of books and whatnot, but I don't have software and how to model these things or anyway. So if you're looking at reverse mortgages, you have to come across Sergio's comments, say, hey, Sergio, tell me about this. And believe it or not, that actually helps me, because the more activity on the YouTube channel, the more the YouTube algorithm overlords love me. They say, oh, all these people are activating or are commenting on Josh's YouTube channel. That guy, we're going to promote it more. So by all means, I'm not saying don't ask me. That's fine. But there are people in a certain expertise more so than I am. Like Ken, the CPA, Ken from Atlanta. I don't know. I haven't seen him here yet today, but every now and again he'll pipe up about tax stuff. That he was talking about something the other day. I forgot what it was, but I didn't know, and he piped in. It was very, very helpful, actually. So anyway, and of course, you all might have some knowledge. Rexpo knows about nuclear stuff. I don't know anything about nuclear power plants, other than I like electricity and I like green electricity. Thus, I like nuclear. So if you have an area of expertise and someone's commenting, by all means, jump in there or asking, because I don't know all the answers. I'll tell you that right now. Los Angeles has many dubious statistics. Yep. And the number one is you can't own firearms. So I will never set foot there again myself because I don't like states that like to take my rights. When you say you don't like bonds, that includes Series 1 savings bonds, but stuff of money. Yeah, Greg, I'm not all that familiar. I don't know enough about the savings bonds. I'm fond of savings bonds because I think some of the older bonds did incredibly well by you. I just a Series I's. I think the inflation adjustment. I like those. I don't have no problem with those. I don't, and I think to sell them, you just go down to the bank and sell them, which is pretty cool. So you already have. I don't think it's a bid ask auction like a regular bond. I think with series savings bonds, you just go down to the bank and they liquidate them right there. They'll tell you the price right there. It's been a long time since I messed with any series of savings bonds. I remember when I used to work in banking, we'd get those on occasion, and we'd have to price them and sell them to the people who bought them in. I haven't looked at savings bonds in a long time, which actually is too bad because I remember I did talk to a couple of people, and they had some savings bonds that were paying a kick-ass rate. And I forgot what it was, but they bought them a while ago, and it was a smoking deal. I know Dave Ramsey says sell them, liquidate all your savings bonds. I don't get that. That just seems a very blanket thing to say. Just liquidate them. I don't get that at all. So I got no problem with savings bonds, not in the least. I just don't know that much about them to give you a more than a lack of an educated perspective for sure. When you withdraw from the Roth, can you specify? Yes, absolutely. So Junk Money says when you draw from a Roth, can you specify principal only? Well, you'd be absolutely. So when you're under the age of 59 and a half, you can say, I got 5,000 in Roth, of which 2,000 is my contributions. I want a check for 2,000. They'll cut you a check for 2,000. That's not a taxable event. There's no taxes, no penalties for sure. So yeah, absolutely. I mean, at the end of the day, the IRS doesn't care. They're just saying, hey, you took your principal out. I mean, they don't really care. Hey, it's not average share price like a stock or anything like that or mutual funds. Just how much did you put in? How much is it worth now? It's always FIFO, first in, first out when it comes to the Roth in that regard. The principal comes out first. So in some ways it doesn't matter. In other ways it does, because if it's under the age of 59 and a half, you know for a fact you're getting your principal back tax-free first, if that makes sense. Not tax-free. Not tax-free, penalty-free. If it's over the age of 59 and a half and you haven't met the 5-year rule, you're still getting your principal, but it won't be penalized anyway because you're over the age of 59 and a half. But it won't be tax-free. Well, your principal will be. Why? Because it's your principal. So I know that's confusing, but it really doesn't matter that much unless you're under the age of 59 and a half. Clear as mud. Am I barbecuing, Joe? Jeez. Joe asked, "My barbecuing this weekend?" Man, of course, man. I just got done grilling some chicken this afternoon. What are we going to do this weekend? I have to think about that. I'm not sure yet, but man, I'm out there 4 days a week in the cold of the wintertime. I'm even out there when it's raining because, I like to have the heat in the summer outside the house. I don't want the heat from the oven inside the house causing my air conditioner to kick on more. So I like the heat outside. Of course, grilling always makes your meat taste better anyway. And it's cheap. It's just cheap cooking. And then our oven sucks, man. It takes forever to heat that sucker up to preheat it. So I forget that. I experimented back in December with doing some oven cooking. And then when I was done opening the oven to heat the house with the residual heat that was from the oven. But man, my electricity bill shot up. I said, yeah, I'm not going to do that anymore. I'm just going to go outside. So I'll bundle up if I have to, my Boston Bruins hat on, but I'm out there all the time, man, all the time. Yeah, there you go. My man Steve says, with a Roth, the IRS assumes principal first. Right on, man. I'm handing my retirement my account, but I would not mind investing in something like balanced index fund. Yeah, I got no problem with Vanguard at all. I mean, again, my thoughts are go the barbell approach, but I got no problem with balanced index funds. Just going to have about 50% bonds. My preference would be not to do that, but don't bother me. It really is. I mean, completely up to what you want. I still like the barbell. That's just my preference. Is there anything like this available that's more aggressive? Great show, as my man Steve says, and he hit the thumbs up right on. Is there anything? The 60-40 allocation seems too conservative. Is there anything like this that's more aggressive? Oh yeah, tons of stuff. Like I have the Vanguard Target Retirement 2050 fund. And I just, that is now 90% stocks and 10% bonds. I've always been a fan of the Vanguard Aggressive Life Strategy Fund, which I think is 70-30. So tons of stuff out there. I mean, just Vanguard's got, you name it, it's got it. They got these ETF. I mean, you literally, you'll go insane, look at the Vanguard stuff, which is one of Jack Bogle's worries about Vanguard. He said, where we have too much stuff, we're taking away from the pure investment of just capturing the market. But it is what it is. What are your thoughts on having the option to buy into Medicare 55? Is that on the table? Are you like buying a Medicare? I mean, is that like your company offering you to be able to buy into Medicare at 55? Yeah, my Steph says, what is my infinite banking? All right, so let me go back to Junk Monkey. Elaborate, Junk Monkey, on the Medicare at 55. Let's put it this way. I'm not for single payer. Ever, ever, ever. It never works. It never will. I hear. So if we're looking at like a Medicare for all thing, I'm not a fan of it. I'm not. It's Medicare is broke. Everyone talks about Social Security. Medicare is the doom one. There's just not enough money. There's not enough money to pay for the Medicare. I don't find it, all these people saying we need Medicare for all. It's nuts. What I would prefer, frankly, is just voucher system. Just like, I mean, essentially, kind of like they do the GI Bill. They said, here's your money. You get $10,000 a year or whatever they're going to pay for your Medicare Advantage policies. And they say, we're going to put catastrophic limits on there. So you get your out-of-pocket expenses of no more than $65, whatever it's going to be. I don't care. But here's the money. You go shop around. Private companies will come out of the blue to freaking meet that demand, as they have with Medicare Advantage. There's a reason why Medicare Advantage is so freaking hard to understand, because there's so many companies competing so heavily for every single penny. Because like my man J.O. says, I mean, this is just, I mean, we're talking millions of people are going on to these programs. And if they can squeeze an extra 15 cents out for profit for each of thousands of people who might buy their program in Michigan, that's a big revenue for them, a big profit margin. And the reason they're doing that is because they say, we know exactly what our costs are going to be, because our actuaries say we know for sure that this is what the cost will be for the average consumer on this wide realm of constituents. And we can, it's like life insurance. Every single unique person is different, but when you combine them into one mass group of people, we can predict the average cost for us will be about $1,350 a head. The CMS, Center for Medicare and Medicaid Studies, pays us $1,600 a head. We know we got $250 profit per head per people we enroll. And so that's what they're competing for. If we can enroll 100 billion people, we're going to be pretty profitable. And that's what the insurance companies are competing for. So I wish they'd do like that. The scary thing to me, though, this is what my dad used to always say we used to be very, very big. And I said this before, I'll say it again. I used to courier for my dad. When I got out of the Army, my dad had this thing called Health Benefits Newsletter. Talk about the wonders of medical savings accounts. And he used to do this newsletter, and he'd plop it in me, and I'd courier it to DC, and I'd take it back to the Russell office building and the other Senate office buildings. I can't remember what they're called, and hand it to the congressman, hand it to the policy analysts and whatnot. And what was I going to say about that? And I'm drawing a blank while I was talking, but man, we used to talk about the idea behind single payer, because back then single payer was Hillary care, and we were adamant against Hillary care because we said it's just this. There's no money for this. We don't have the cash. It always comes to rationing, and I was going to say something else about that. I forgot. And the facts are, rationing sounds good unless you have one of the symptoms that's not rationed to provide for, and then it doesn't sound good anymore. That's what I was going to say. So now we get all these doctors. Just because we have health insurance doesn't mean we have health care. And the biggest concern that has been around for a long, long time is more and more doctors, primary care physicians, OBGYNs are getting out of the business. So it become fewer and fewer OBGYNs. I get Medicare, I get it. You're not having an OBGYN, I get that. But still, fewer and fewer providers for more and more demand. And what happens to that then? Then you get 15 minutes with your doc, and that's it. And after 15 minutes, they got to shuffle you through like you're in the cattle cars back in basic training at Fort Benning. It's nuts. And so this is the problem that we have. Everyone conflates insurance with care. I don't give two craps about insurance. I want the care. And that's what, anyway. The thing finally, just let me real quick, the thing that drives me crazy about these politicians, These freaking politicians aren't going to be sitting in the same waiting room as you and I guarantee, when they do this Medicare for all for single payer thing. They're not going to be sitting there waiting like you and I are going to have to. No way. Like John McCain, remember all that stuff he had to deal with this? I mean, you know, RIP. I guarantee that guy wasn't sitting in the same waiting rooms you and I would be. Guarantee. It's nuts. I mean, these are supposed to be our. All right, I'm going off a tangent. What do I think about infinite banking? Says my Steph. Not a fan. Not a fan. I had a quote unquote debate with a young insurance broker on this channel not too long ago. It was sad to me because I could tell he had drank the Kool-Aid, and it's just sad because he's going out there drinking the Kool-Aid, not recognizing what is truly going on. And the issue that I have is the idea, that they're going to have cash value that increases at a 6% rate or whatever they're talking about. And that's what he says. He said, we're paying 6%. That is your crediting rate. That's not the net that you get on your cash value. And so as debating this guy back and forth, I said, all right, drop $100,000 in your stupid infinite banking thing. What is my cash value worth next year? $94,000 or whatever it was. I said, wait a second. You said you're paying me 6% a year. Well, you're not paying me 6% a year. If you're paying me 6% a year, it'd be worth $106,000. Well, then he said, well, you have to factor in surrender charges. Well, then you can't. All right. So what's it worth after 10 years? $100,000 in this case. I'm just, basically it's worth $100,000. I said, so where's the 6% a year? I mean, you're saying you have to factor in surrender charge. You're paying me 6% a year. After 10 years, though, my $100,000 is worth $100,000. I have not made 6% a year. And yet you're advocating, you're arguing that that is what's happening. It's absolutely not what's happening. If I was getting 6% a year, I'd have more than $100,000 cash value after 10 years. It's that simple. Because he's saying it's Mass Mutual. We've been paying 5.5% to 6.5% every year since 1922 or something like that. Okay, what's my cash value today? What's my cash value 10 years from now? If I'm getting 5.5% or 6.5%, it's very easy to calculate. Just take your trusty Texas Instruments BA2, and you can do a quick calculation. And it's not 6.5, it's not 5.5, it's not. It boggles my mind. And so you're going to argue that they're going to get that on the cash value, and on top of that, you're getting this increasing insurance component. And then even worse is that these guys, look, I got a good friend in this business, man. I love the guy, but oh man, he's trying to say you put, I can't remember, 15,000 a year for 10, 15 years. You'll be able to take 25,000 a year for the next 30 years or something like that. I said, just how? I'm not a fan. So hey, when it comes to infinite banking, it's whole life insurance, that they're going to argue that you're basically banking on yourself. I did a video on this a long time ago, and I'll have to maybe find the link. I've got 1,000 videos to be out there. It's going to be hard to find, but if you type in infinite banking, you'll see my video on it because it bothers me. I'm just telling you right now that you're going to say, I'm getting a 5.5% to 6% crediting rate on my life insurance component. Now, the first thing I want to know is, let me see that in what's called an in-force illustration, that my cash value that I have walk away money is worth 5.5% to 6% more than it was when I started the previous year. I just want to see that. I want to see the illustration on that. If you can't show that to me, that I'm not getting 5.5% to 6%. Now, the company may be crediting my account 5.5% to 6%, but after fees and commissions, I'm netting 1 or 1.5. So don't tell me your stupid crediting rate is 5.5 to 6.5 if it doesn't show up in my back pocket. I don't care what you call it. Semantics. You can call it crediting rate. You can call it my interest rate. All I care about is what nets to me. And if I'm not making that 5.5, 6% walk away money, then what you're saying is completely fraudulent. It's a fallacy. I know this might be a little bit too over the top for some of y'all, but be careful on there. You want to see the illustration. What's my cash value today? What's my cash value 5 years from now? What's my cash value 10 years from now? And I'm just telling you right now, if it's sold to you by an agent, your cash value today will be the equivalent of your cash value 10 years from now. There's just no getting around that. And so if it is, then you have made no money. Now, with that said, is there a benefit to that? You have the life insurance that you had it for free because you started with $100,000, you end up $100,000, and you had 10 years of coverage. So you lost no money. Now, you did have an opportunity cost that you could not invest that money elsewhere, but still, you had a significant life insurance coverage for those 10 years that literally costed you nothing other than the opportunity cost of what you could have done with that money that you put in for the life insurance policy. But still, you got $100,000 on both sides of the equation, and you had that whole life insurance for the whole 10 years. That's not a bad deal. That's the way it should be sold, not sold as you put it. It's nuts. All right. So Devin had a video on Medicare at 55. I haven't seen it. I have to watch that. What do you think about USA mutual funds? Get the H out of Dodge, man. Just talked to a good friend of mine down at USA today. It seems like USA is falling apart. Love USA, 4 generations, worked there 10 years. It just seems like it's falling apart, man. I don't know what's going on down there. It's not good. Get out of there. There's no other way around it. They sold to Victory Capital. They're trying to sell their wealth manager. They're just getting out of the whole business. They don't. In fact, what she told me is that, remember, you used to go to USA and say investments, retirement, insurance, and banking. Now it doesn't say, I haven't looked, but now it doesn't say investments or retirement. So what's going to happen is they're just going to sell life insurance and annuities going forward, and apparently their banking situation I don't know what's happening. I was talking to her and I said, what the hell is going on? I don't get it. I don't get why. It's nuts, man. And apparently the new commercials, they don't even make any reference to investing or retirement either. It's sad. It's sad. I don't know what happened. I don't know what happened, but USA went through a similar thing to this back in, I guess, the early to mid 90s. The CEO, I think it was McDermott. I can't remember. But anyway, the old CEO, and I can remember his name in my head. I forgot his name. But anyway, they had a lot of fluff, man. It was like an old boys club for officers. Retired officers didn't have a job. Come to USA. We'll give you a job. You might not do anything, but we'll give you a job. Then they had a guy named Bob Davies came in there, who apparently was a hard charger, kind of a dick is what I hear. I didn't work for him. Not the nicest guy, but he got up there and he got rid of a lot of the fluff, and a lot of people were mad at him. But he said, look, we're going to run this a business. We can't just be giving away the store to, an old 04 from the Army that you knew at the Pentagon that can't find work. He's not going to come here and get a job. And so Bob Davies went up there and cleaned house, and that made a lot of people mad, but it really made USA put it on a good pedestal in terms of financial solvency. That's not the right word. Financial, I guess, strength is probably the better word. I don't know what's happening now. It's not like that. They're reorganizing. I guess the mortgage company just laid off a bunch of people. The mutual funds, like I said, they sold to Victory Capital. Who the hell is Victory Capital? I don't even know. They're trying to sell other parts of the firm. It's just, it's bad. I don't know. I don't get it, man. And breaks my heart because USA is such a fine company, man. And I don't know. I think executive leadership. You ever heard of the Peter Principle? You're promoted to your highest level incompetence. I think that happened a lot at USA, frankly. And I think USA succumbed to the idea that they had a lot of cash resources and they didn't know what to do with it. And like a lot of companies, they started reaching beyond their core competency. And when that happens, it makes the executives feel like, they could go see Robert Griffin Jr., for instance, RG3. Remember when RG3 just came out of Baylor with the Redskins? We were sponsoring all kinds of NFL games. I think the executives, they love that idea of rubbing shoulders with these people, and it didn't serve the membership well. There's no other way around that. And it breaks my heart. I got to tell you right now, I'll probably shop after about a year for some other. I'll look around because the lady I was talking to, she told me, she goes, man, a lot of people are leaving USA because they're getting better rates elsewhere. And now you got to be careful on just rates. This is not mutual funds, Brian, but it's got to be service too. When you file a claim, how quickly is your insurer going to file the claim? And for me, the claim I just had last year, USA was on it like white on rice. So I like that. So I'm fond of how quickly they dealt with the claim. But I'm paying a pretty significant premium for that quickness. And a claim I've only had one claim ever. And I've been a member since 1988. And so I don't know what's going on, but if you're not planning on filing claims anytime soon, and you're paying a pretty hefty premium, and back 10 years ago, you weren't paying a premium. They're paying discounts and still getting good service. A lot of folks attribute it to opening up for enlisted. I'm starting to think there might be some validity to that, which bothers me as an enlisted guy. I thought the enlisted guys coming on board was the right move. I'm starting to think maybe not. I think I'm starting to think that might have been a bad move, and I think we're seeing that now in the level of service and just the mess. Anyway, that's my thing on USA. Medicare can't negotiate prices. They pay top dollar for everything, says Nancy. Basically would add Medicare as an option in the marketplace for those fit. Well, I got no problem with that. If they, you would pay amount the government pays would not be, Medicare is not free. I can't tell you people think Medicare is free. Your Part B premiums, man, it's $135 a month right there. Your Part D is another $35, and you've been paying what whatever it is for your Part A, your whole working career. So Medicare is free. No, it's not. It's in fact, it's even worse than free because it's running significant deficits that we just can't afford. We now have pharmacies show all their expenses and costs. Let's see here. All right, Doug, we're great show tonight. Thanks, Doug. People all the time tell me paying cash is way cheaper at the hospital, which if true sounds nuts. I hear both sides of that, Steve. I hear that too, but I'm not sure I believe that. Frankly, I don't know. I went to urgent care. We had a swipe for one of my kids for a strep. You know what I'm talking about? This is one of my like my last day on my USA insurance. Matter of fact, I said, hey, what if I pay cash? And it was like $200 through insurance. It was $140 cash money, which was good. But I don't know that to be true. If I had a broken bone or something, I don't know. And that's the whole thing with this insurance thing. We just have no clue what the fees are going in. You have no idea. Now, if you're if you have a heart attack, are you really going to take the time to do the due diligence to call the ambulance providers of the hospitals to make sure their fee schedule is appropriate? No. I mean, so there's always going to be some flux there. But I mean, for scheduling outpatient surgeries and scheduling appointments and scheduling, various things, is routine things. It seems to me that there should be, like I advocate for financial planners, put your damn fees out front, let people see. Direct primary care, DPC, by the way. I'm telling you, I did an interview with a lady in Texas, matter of fact, Fort Worth. I forgot her name off the top of my head. On my podcast on direct primary care. I'm a big fan of that. So look at DPC, direct primary care. Man, I wish I could remember her name. She's a black lady out of Fort Worth. She's great. I loved her. I tell you, it's like it's like a concierge thing, like for $100 a month, they still blood tests. They do all the stuff that you would do in a regular PCP, primary care physician. But it's $100 a month or something like that. And, she takes, man, I wish I could remember her name. So I'd love to refer her to you guys, but I can't remember. I forgot. It's too bad. Kurt just looked at the VFIX, exactly what I was looking for. There you go. Let's see. Have you heard of the taxing bodies in New York checking people to verify? Yeah. So my man Grover says, have I heard the taxing bodies in New York checking people to verify they're no longer residents? So here's, as well as worse than that. So there is a guy, a hedge fund manager or investment manager of some sort, who lived in Connecticut. He worked in New York, but he lived in Connecticut. And I think he didn't even work in New York that much, or he had I can't remember what the story was. This is back in 2008 and 2009. New York state made him pay in-state income tax or property. I think it was in-state income tax. And he goes, no, I'm not doing that. I live in Connecticut. And you can read it. Look online. I forgot the guy's name, but there's a case and went to the New York Supreme Court and he lost. He had to pay full-time year-round resident to the state of New York income tax, even though he absolutely lived in Connecticut. It's not debatable. He maintained his home, his car, his voting, all that stuff was in Connecticut, but he lost. And along those lines, and I don't remember what New York estate tax is. I can't remember. I have to revisit all this. I haven't done any videos on estate taxes yet, and I need to. But anyway, so New York State had a pretty elaborate estate tax. I think it used to be $1 million was the exemption. And they wanted that money big time. And so I've never talked to this guy, another hedge fund manager, he's making bank. And I'll never forget, this is one of the reasons I can't stand these hedge fund managers, because they're making so much money and they're not doing anything other than pushing papers. But anyway, this guy had probably $50 million in net worth, living in New York. I said, man, you're going to get killed on estate tax. And he goes, New York will take care of me. I said, are you a friggin' fool? You're going to get killed. And they're just saying, he didn't believe me. And he said, New York will take care of it. They'll be all right. They won't kill me. Hey, nuts. So yes, New York State is notorious for going after people big time. So Bruce, you better get out of New York. That's for sure. Victory Capital bought them out. Yeah, right on. So the same as, yep. And I don't know who Victory Capital is, and I don't plan on finding out, to be honest with you. In fact, it's interesting. I still have, actually just occurred to me, I still have my brokerage stuff at USA. Probably have to move that out. Too bad. Spread the word. Let's get Josh to 20K subscribers by this summer. Right on, Sergio. I'll send you your check for that later. Just joking, regulators. I was just joking. YouTube algorithm. I'm just joking. We're not doing a sub for sub. I have not done a video on QLAX. I'm not all that knowledgeable on it, Pandora, on QLAX. Something I need to read up on. And deferred income annuities, I have a relatively new product as well. So QLAX, relatively new product. DIAs are relatively new products. I'm just not up to snuff on them, but I will be. I know them. I know kind of how they work. I just haven't looked at them for a long time, a couple of years. You know, I wish our company was more worried about employees and about the earnings, which are sometimes unrealistic. Companies worry more about stockholders and employees. No, I 100% agree with that, Steve, because that's where the executives get their big fat bonuses and are able to keep their job. It's the quarterly earnings. And Trump, love him or hate him, he tried. He said the SEC, he wanted to change those stupid quarterly earnings things that you have to report. He said, screw that. Let's do it on a yearly basis. Let's at least try to encourage more long-term investment behavior. And just like most things in Congress anymore, DC anymore, just falls by the wayside. It's a wonderful proposal. Forget the quarterly earnings reports. That increases bad behavior by executives. Let's look at year over year. We don't have to do the quarterly thing, but no one listens. Hospitals now are required to give you an estimate. Pharmacies and supply costs are said to be added to this year. Oh, that's good. Well, she'll see. Nicole Delgado, Montana. Nicole Diana Delgado, Montana. Hello. Sounds like a Latin name, Nicole. Where are you coming from? That's we had a guy from Israel on here. One time I had a guy from, I think it was Norway, who I cracked him up by my pro-U.S. stance. I love America, folks. I do. That doesn't mean I don't like Israel or I don't like Peru or wherever you're calling from. Or Norway. I love America. America is where it's at. And I fully intend to be here as long as the good Lord keeps me. That's for sure. Life, my man Robert says, wife left a job a few years ago. She forgot about her 401k. It's worth $125. Yes. So can we move it to her new job's 401k Roth? Can we take tax from the 401k? Yes. Affirmative to both those things. This is a tough one there. I'm not sure I would do 125 into my Roth while I'm presuming both of you guys are working, because at least she is. If she got earned income, man, that's that right there alone will put you in the 22% tax bracket. Presumably she has earned income as well. So she could be looking at a 24% tax bracket. And yet if you just wait until y'all quit working, you'll quickly find yourself in the 12% tax bracket. So it's the golden age of tax planning is when you stop working before RMDs, required minimum distributions, kick in. The golden age. And so I'm telling you, man, I'd wait until I stopped working, usually 62 years old to 70. 62 to 70 is the golden age of tax planning. I would wait until then. Along those lines, I did have a question that someone emailed me the other day. He says, what was he asking me about Medicare? When is the cost of Medicare Part B and D figured out? And so it's going to be 2 years previous. So remember, your Medicare Part B, all right, that's your hospital insurance is Part A, your physician services is Part B. That's $135 a month premium. Now, that is based on if your income is less than a certain threshold. Let's see. For 2018, if you're married filing jointly and it's your modified adjusted gross income is $170,000. If your modified adjusted gross income is for a single taxpayer is $85,000, then your Medicare Part B is $135 and Part D is roughly $35. Once you break over those numbers, it starts going up, and it starts going up pretty drastically as well. And so that's going to be based on the 2 years previous. Does that make sense? So if you're going on Medicare now, they're going to base your premiums on what you had from 2017. All right. So the issue about conversions as you get older and more closer to Medicare is that could have an effect on your Medicare B and D premiums, which is a drawback about doing $125,000 conversion right when you hit your retirement age, because that could easily put you above the 170 threshold. But 170 is a lot of flipping money, man. And so if you're not earning income and you're saying, I want to keep below the Medicare premium increases, you got a lot of wiggle room there. And so you start saying, maybe instead of converting a whole 125 in one fell swoop, I'll convert 40,000 this year, 40,000 next, and 40,000 next. And that will keep us below the threshold for Medicare premium increases. I hope that makes sense. VP GDX instead of annuity. Rexpo, thanks for sharing thoughts on precious metals. Gold sounds like I need to buy a few coins. I already invested a very sizable amount to my precious metals of choice, lead and brass. That's right. Better get that AR-15 before before they're made illegal. Rexpo, only buy gold coins that are close to spot price of gold. My Roth is at Brian. My Roth is at USA. And I tell you, Brian, I'm thinking the same thing. I just probably put mine to Vanguard, frankly. Now, for me, I don't want to. So going back to what someone asked, an hour and 15 minutes ago by Dustin and Jazz Wealth. If you want someone to run the money for you, just go to my man Dustin over at Jazz Wealth. They'll do it fine. I got nothing but confidence in that guy. If you're going to do it yourself with just basic index funds, it's going to be tough to be Vanguard. It really would be. I did a video about a year ago on the Charles Schwab Intelligent Portfolio. I like that quite a bit. I looked at it very, very favorably. I just like Vanguard. Vanguard is because it's owned by the shareholders. Schwab is stockholders owned it. Going back to what some guy said before, Steve in Texas, about the company needing to appeal to shareholders more than employees. I think that's 100% spot on. Schwab is a stock company. Fidelity is owned by the Johnson family. Vanguard is owned by you and I as Vanguard shareholders. So for me, I always default to Vanguard, rightly or wrongly, but I like the fact that the number one priority are the shareholders because they own the company for sure. Not the shareholders like owning 100 shares of Charles Schwab stock. They're literally the mutual fund owners. So I'm going to probably move mine to Vanguard, actually. Medicare is auto-deducted from Social Security payments, right? Yeah, absolutely. So now here's the problem, though, Jen. If you are taking Medicare at 65, which you certainly should. I mean, Part A is free because you paid for it before, but everyone thinks it's free. How are you going to pay for that? Well, you're going to get invoiced if you're deferring Social Security, like you and I have kind of chatted on relative to the YouTube channel. So you just got to make sure that you pay that bill because they're going to invoice you. That's what Medicare will do. CMS, Center for Medicare and Medicaid Study Services, they're going to invoice you, and you just got to make sure you pay that sucker. So once you hit 65, 3 months before 65, at least sign up for Part A. Look, I'm not an expert on this by any stretch, my friends. I would look at finding a broker to help you with all this stuff. Brokers get paid commissions by the insurance companies. That does no effect on you guys whatsoever. I'm just telling you right now, it doesn't cost you anything. You don't pay more for a certain brokerage firm to put you in product A versus product B. It doesn't work like that. But with that said, they do have an incentive to get you in the door so they can sell you something. But I got no problem with that because, I mean, my goodness, the freaking thing is insane to understand. No one can understand this. I mean, what's his name? Albert Einstein couldn't understand this. And so I think he's smarter than all of us combined. So it's nuts. So get a broker, let them figure it out for you. They know this. They do this daily. Just remember, even if you're staying on your employer's plan, a lot of employers will want to put you on Part A anyway when you hit 65. So just keep that in mind. And how you're going to pay for Part A and or Part B and or Part D if you're not taking Social Security, you're going to be invoiced for it. So if your mail lady, starts acting crazy and you don't get your Medicare premium invoice, well, it's going to be on you to pay that sucker. So just keep that in mind. My man Great Riff is here, says I moved to Vanguard. My thoughts were got too bad in the U.S. The goal would really matter, being able to defend yourself and friends. Yeah, I agree that, Rex. I'm optimistic, man. A lot of people are nervous Nellies about the U.S. You know, there's a civil war. I was watching this guy Tim Pool, watch I like a lot actually. He's a lot more liberal than me, but I like him. I think he's got a good channel. He says the upcoming, civil war. And I don't believe that. I think most people just live in their lives. I think you got, stupid Twitter and people acting all stupid out there. And you got, I don't even know what's out whatever the alt-right is. I'm still trying Richard Spencer, but he doesn't have anybody. I mean, who knows? I just don't think there is one. This idea that there's a civil war coming, that we're all going to be at guns drawn. I don't buy it. I just don't. It's nuts. And it's easy to get falling to the negativity when you see the media and you see so many bad actors that dominate the space, but most people just trying to live their lives. In fact, if you look at America, and this is why I said in my video about the black girl in Chicago getting shot, which still boggles my mind that no one seems to care unless the perp is just no one cares. But if you take away certain communities in various cities in the United States, we're safe as can be. There's just no getting around that. Now, that doesn't make it right. These young kids getting shot, and it just doesn't make it right. It's not good. It's not good. It's people losing their lives for being in the wrong place at the wrong time because a society has been turned upside down in that certain area. It's bad. But everybody else is safe, and I just don't think that we should be all worried about crime and criminality and all that. That doesn't mean look. I have firearms. I have a few. Let's just put it that way. But at the end of the day, it's a pretty safe place we are in the United States, and I think a lot of people, they read the news that the media leads them to believe, which is if it bleeds, it leads, and man, I just wish they'd focus more on the innocent victims, like a 2-month-old boy was shot in Chicago. Gangbangers pulled up to a guy's car, not a guy, a lady's car, and just fired away. Now, was she engaging in bad behavior? I have no clue. But there's a freaking 2-month-old baby got shot in the head. No one cares. No one cares. It wasn't on freaking, what's that dude's name? Anderson Cooper. All right. Let's see. Oh boy, I could use some help with my IRA to Roth conversions to keep my future Medicare down. Yeah, that's no, right on, Nancy. Yeah, you're right. Let's see. Do you like Big AI's rebuttal to Rick Edelman? Oh, Big Al, right? Yeah. Yes. Man, so was it Pure Financial? Is that right? I love those guys, Joe and Big Al on Pure Financial. They do a YouTube channel, which I watch all the time. I'm a fan of what they do. And Big Al and I see eye to eye. He doesn't know who I am. So Rick Edelman was against Roth IRAs. His number one reasoning was because Congress is going to change the rules of taxing. Maybe I'm sitting there. So Rick Edelman was against Roth IRAs because the potential for Congress to tax Roth IRAs in the future. And I said, well, hell, you better be against everything because the potential of Congress to do anything in the future. What is that? I said, man, and like Big Al said, anytime they pass some kind of legislation, it's always grandfathered in. The idea that I'm not going to use the most benefit. That'd be like saying don't get life insurance because Congress at some point will get rid of the tax-free nature of life insurance distributions. No one talks like that. I mean, the people who talk like that are just Looney Tunes. I mean, could they ever get rid of the tax-exempt nature of life insurance proceeds? Sure. Will they? Probably not. They could, and they'll probably be grandfathered for people who already have life insurance. I mean, politicians aren't stupid. I mean, they're dumb. I get that, but they're not. But they know their political survivability. They're not going to piss off all these people who did. When I heard that Rick Edelman was saying that, I said, what is wrong with this guy? I'm a fan of Rick Edelman, but that just seems drastic, draconian talk that they're going to get rid of the tax-free distributions of Roth IRAs. I just find that to be silly. I mean, okay, we can, again, don't buy life insurance because they could get rid of the tax-free nature of life insurance. I mean, there's always talk about that. You better not have an estate because your estate, there's always Charlie Rangel wants to have a $1 million estate exemption. That's it. I mean, so it better not have any kind of net worth, because Charlie Rangel is going to get, you know, I don't even know if he's on House Ways and Means anymore. He used to be. I don't think he is anymore because he didn't pay his taxes, but he wanted that. A $1 million exemption on estates. That's it. Anything over $1 million was taxed. Back in the old days was 55%. The old days being when George Bush II was a president. Hey, so don't get an estate because Congress might come and get your estate. Doesn't make sense. Yeah. Anyway, that's my take on that, Fred. I won't address the second part of your statement. Invoices for 3 months, not monthly on Medicare. Okay, there you go. So Jude's 121 says they invoice on Medicare every 3 months. So there you go. So that'd be easy to fall under the wayside if not careful. Should you roll 401k Roth over to Roth IRA when you roll off? Yes. It says yes, says Kenneth Walters. You got a 401k Roth. Should you roll that to Roth IRA? 100 absolutely %. And the reason for that is because there's no RMDs on a Roth IRA, but there are on a Roth 401k. My man Bruce, even dollar bill, says trust in God, not government. Yeah, 100%. Franklin, I have 19K in the Wellesley Income Fund, a non-qualified account. I like this fund a lot. I'm thinking about moving some qualified money. Man, I got no problem. Wellesley. Wellesley and Wellington, I mean, the numbers speak for themselves. I got no problem with that. Do I say any issues? You're going to have bonds in your non-qualified account. And frankly, Franklin, that is just going to give you ordinary income tax. I'm not a fan of having bonds at all, but especially in a taxable account, because the bonds from the Wellesley are paid to you as ordinary income. You have to pay taxes on that as ordinary income. Where if you had stocks in that account, if you had any distributions at all, it come out as long-term capital gains and qualified dividends most likely. And if you're in a 12% tax bracket, you don't pay any tax on that. But any income that you get from a bond, Wellesley is predominantly a bond fund, is coming at you as a taxable income. And there's no, I mean, it's ordinary income tax. So you're paying tax on it regardless of what your tax bracket is. So I don't like having bonds in taxable accounts at all, but I don't know what your cost basis is. So I'd be careful just selling it, because you'll heard old Josh saying no bonds in taxable accounts, because I mean, you might have a cost basis of a penny. I don't know. So just be careful there. Are there any advantages of Roth 401k over Roth IRA? Yeah, put more in it. Absolutely. So the Roth 401k, you can put, I think it's what, 18,500 this year. If you're over 50, you can put 24,500, something like that. So that's a pretty significant advantage. Yeah. So there's some. All right, my friends, I'm winding down here. It's an hour and a half on here. I'm about to hit the wall, but man, I appreciate y'all. I just want to say that it's nuts. You know, at one point I had almost 90 people on here at one time. It's crazy. It's crazy. So I appreciate y'all being here for sure. Put comments or questions. I'm going to do a video tomorrow on the updates on Social Security for 2019. I have a friend, I would call her friend, Elaine Floyd, who's my Social Security maven. She knows all things Social Security. So every year she puts out this seminar, it's a webinar thing, which I pay for to share. And I'm going to do that tomorrow. And I'll probably I'll put that on there, and then I'll probably do what's called a premiere thing on YouTube. I've never done a premiere thing, but that means you all can watch the video, and I'll be on there to answer questions. I won't be doing it live, but you can see the video with Social Security. Then you can fire questions away while I'll be there live while I'm watching the video myself, if that makes sense. It's a relatively new thing YouTube has done. I think there's a lot of benefit there. That way you have some content going on, and you can still have side discussions about the topic at hand. In this case, it'll be Social Security, because I think it's pretty important. So Massachusetts, right on. Go Bees. So that I might do that tomorrow. I might do the next day. But anyway, just be on the lookout for that. And if you have questions on that, you can certainly put them in the comments as well. All right, guys. Mary Hampton, good to see you, man. Good to see you, or ma'am. All right, we'll see you guys later. Thanks, guys. Bye-bye.